let's get right into today's high-density daily macro explainer. We're going to break down all the major overnight developments and, more importantly, map out the technical setups for major asset classes so you're ready for the session ahead.
The absolute biggest domino falling today, well, that would be Brent crude. It just surged right past $95 a barrel as some really severe supply fears grip the global energy markets. Oil traders are clearly throwing any diversification memos right out the window today. They are pricing in serious, immediate risk, and it is sending shockwaves across pretty much every other asset class we're going to cover.
And this spike isn't happening in a vacuum. It's being driven by simultaneous disruptions across three incredibly vital energy routes. You've got the Strait of Hormuz, which remains heavily constrained. Then Iran-backed Houthis are actively expanding their threats into the el-Mandeb Strait. And on top of that, Ukrainian attacks are continuing to disrupt Black Sea exports. It is literally a triple threat to global supply.
Now, behind all these disruptions are escalating geopolitical tensions. Any fragile hopes for peace we had last month? Yeah, those have completely evaporated. We're now seeing U.S. strikes on Iran entering their 12th night, which is prompting fresh retaliatory attacks across the Gulf. Combine that with new tariff and strike warnings from President Trump, and, well, the rhetoric is just escalating. Markets are basically being forced to price in these headlines faster than diplomats can even schedule a meeting.
So what does this all mean for the broader market? This tension is spilling right over onto Wall Street. Listen to this crucial quote from the Fed's Christopher Waller. He explicitly noted that if an asymmetric shock hits energy prices, the FOMC is fully equipped to hike rates to maintain price stability. That hawkish shadow is exactly what is driving the bond market right now.
Moving on to our Wall Street and Europe watch. Inflation fears versus encouraging data.
Over in the U.S., Wall Street was pretty subdued overnight. We've got higher oil prices pushing Treasury yields up to actually test their May highs. Interestingly, despite those rising yields, the U.S. dollar stayed broadly flat, kind of grappling with the recent cooler labor data we got. Meanwhile, gold rallied nearly 2% as folks actively looked for a safe haven. But look, it wasn't all doom and gloom. Corporate earnings stayed in focus, and artificial intelligence-related names continued to absolutely outperform. It just proves AI can still steal the spotlight even during major geopolitical turmoil.
Jumping across the pond to Europe, it's really a tale of two economies right now. The UK was greeted with some highly encouraging disinflation data right on the new Prime Minister and Chancellor's first full day. We're talking CPI dropping to 2.6%, alongside lower government borrowing and better unemployment figures. Compare that to the Eurozone, where a surging German 10-year Bund yield, which just hit 3.2%, is severely complicating the ECB's anticipated rate hold at 2.40.
All right, let's get into Section 2, major currencies, specifically the tactical views and technical levels.
Let's run through the tactical dashboard for the majors. Take note of the dollar index. Despite lagging behind the yield spike because of those cooler labor prints, the DXY is still a buy on dips. You're looking at support around 100.89 and resistance at 101.41. For EURUSD, the pair remains a sell-on rise ahead of the ECB pressure, capped heavily by resistance at 1.1447. And for the pound, it's a cautious buy on dips, at least as long as it holds that crucial 1.3315 to 1.3326 support zone. But what's actually driving these setups? The soft points behind these technicals are super important. The pound is tapping the brakes specifically because of that softer 2.6% CPI print, which really tapered rate hike expectations. Meanwhile, for the euro, literally all eyes are on the ECB press conference today. Since rates are expected to hold, traders are bracing for the commentary, specifically how the ECB plans to navigate geopolitics as the main driver for their forward guidance. Meanwhile, over in Japan, we're basically watching a giant game of chicken. Intervention warnings from Satsuki Kaneyama reiterating readiness for bold action are definitely keeping traders on edge. But the reality? So far, these threats haven't meaningfully moved the yen. The fear of intervention makes this a really uneasy trade, but the underlying trend is still heavily intact. So, for USDJPY, you kind of just have to trade the price and tune out the noise. Tactically, it is still a buy on dips. As long as we stay above 162.71, your target is 164.11. Just keep an eye on the recent high of 163.24. That's a key level it needs to clear. Now, given the intervention threat, an alternative play for the bold is to sell at current levels, but you absolutely have to use a very strict stop just above that high at 163.30.
Wrapping up with Section 3, India markets, focusing on the Nifty and USDINR technicals.
Starting with the currency, the rupee definitely felt the heat today.
It drifted toward its all-time low, closing at 96.565. It was heavily pressured by those surging oil prices we talked about and a stronger dollar. Now, aggressive dollar sales by state-run banks did step in as a crucial buffer to limit further losses. Tactically speaking, the USD/INR remains a buy on dips. Your target is that all-time high area of 96.90, with solid support sitting at 96.18 and then a bit deeper at 95.83.
Moving to Indian equities, the Nifty logged its biggest single-day decline in 2 weeks, dropping over 191 points. But under the hood, we saw massive sector divergence. Pharma took a direct, heavy hit from the newly announced U.S. generic tariff plans. PSU banks, realty, and IT also bled pretty badly. On the flip side, defensive buying in auto and FMCG provided a much-needed cushion. I mean, we saw a massive 6% surge in Bajaj Auto right after their strong Q1 earnings print.
So technically speaking, the Nifty closed just shy of that psychological 24,000 mark, settling at 23,996. The broader buy-on-dip structure is actually still technically valid, but I'll tell you, it's hanging in the balance right now. It relies entirely on holding that critical 23,900 to 23,965 support zone. If that zone breaks, the structure changes entirely, and we could easily see a deeper slide down to 23,576. On the upside, resistance is going to cap any rallies at 24,137 and 24,344.
So, as we wrap up today's explainer, I want to leave you with this crucial thought for the trading session ahead. As oil pushes $95 and global supply chains remain under siege, can central banks actually successfully maintain price stability when faced with such unpredictable and asymmetrical geopolitical shocks? Honestly, it's the multi-trillion-dollar question for markets right now. Make sure you keep your stops tight, trade the levels, and we'll see you in the next explainer.